Hey there! Imagine you and I are sitting across from each other in my office right now. You're getting super close to retirement, and we're looking at how to protect your hard-earned life savings. Well, welcome to this explainer. Today, we're going to break down your absolute best options for a secure future. And we're going to look way past just the raw numbers and really dig into the emotional reality of managing your money over a multi-decade retirement.
Because let's be real, this is the ultimate nightmare scenario, right? What if the market just tanks the very day you retire? I see this fear with clients all the time. It literally keeps people up at night. So, okay, let's just dive straight into this terrifying but honestly very realistic scenario to see exactly how human psychology reacts. Because the hard truth is, a mathematically perfect strategy is completely useless if panic makes you abandon it at the worst possible moment.
So here is our game plan for today. We'll start with the nervous retiree's dilemma, move through the psychology of dividends, do a reality check on index funds, expose some taxes and hidden risks, and wrap it all up with the ultimate strategy showdown. All right, part 1, the nervous retiree's dilemma.
Okay, say you need $50,000 a year in steady income just to live comfortably, but the market feels incredibly shaky, the news headlines are totally terrifying, and you desperately need a strategy you won't just ditch when things inevitably get rough. To understand our first option for getting you that 50 grand, we have to talk about the dividend yield. It's actually a super simple concept. When you buy a stock, you become a tiny part owner of a real-world business. And some massive, established companies, think your Coca-Cola's or Johnson & Johnson's, they make so much profit that they can't effectively reinvest it all into the business. So they just give a cut of it back to you in cold, hard cash. If a stock costs $100 and pays $4 a year in dividends, boom, that's a 4% yield. You literally wake up and cash has just magically been deposited into your account.
Now, on the other side of the ring, we have the index fund strategy, and this relies on a totally different concept called the 4% rule. This is a very widely studied withdrawal strategy. But instead of sitting back and waiting for a company to deposit cash into your account, this rule says that you have to actively sell off pieces of your broad market portfolio to generate that exact same $50,000 of income. And historically, you can safely do this over a 30-year retirement without running out of money. But I want you to think about how this actually feels from a behavioral standpoint during a massive market crash. It's night and day. There is a world of difference between waking up to an automatic cash deposit on your phone from your dividend stocks versus the visceral, stomach-dropping anxiety of being forced to actively log in, hit the sell button, and liquidate your shares while the market is in a total free fall. I mean, it is the ultimate test of long-term investor discipline.
Moving right along to part 2, the psychology of dividends.
Let's look at why this path offers what I like to call the dividend comfort blanket during periods of wild market volatility. See, there's this special category of companies known as dividend aristocrats. Companies like Procter & Gamble don't just pay regular dividends, they actually have a rock-solid track record of increasing their payouts every single year for over 25 years. Talk about a massive psychological advantage. It means your income actually grows consistently, acting as this fantastic shield against the rising costs of inflation over a multi-decade retirement, even when the broader market looks terrible on paper.
So, what's the magic number for our nervous retiree? Well, to safely generate that $50,000 a year without ever touching your original principal investment and assuming a very realistic 3.5% yield from quality dividend stocks, you'd need a portfolio of roughly $1.4 million. The beauty of this? Your underlying principal just sits there intact, and the cash just keeps flowing. It acts as an incredibly powerful anchor for your behavioral discipline.
Okay, part 3, the index fund reality check. Now, contrasting with that cozy comfort of dividends is the mathematically superior yet sometimes emotionally brutal world of index funds. This is the raw efficiency of just buying the whole entire market. It's a core philosophy that was really popularized by Vanguard founder John Bogle back in the 70s. His big argument was basically, hey, most professional managers totally fail to beat the market over time, so his solution? Just buy a simple index fund that tracks something like the S&P 500. You get this extreme, automatic diversification across hundreds of the largest companies on Earth, and you pay rock-bottom fees. We're talking sometimes as low as 0.03%.
If you go this index route and use that 4% rule we defined earlier, you actually need a similar or maybe even slightly less amount of capital to hit your 50 grand income goal. You're looking at roughly $1.2 to $1.5 million. And why is that?
because by owning the entire global market, your portfolio generally captures faster overall growth over time compared to just holding those slower dividend-paying companies.
And historically speaking, the data heavily backs this up. Over long stretches, tracking a broad index like the S&P 500 has delivered a really robust 8 to 9% average annual return. Just think about the last 3 decades, riding through the massive growth of the 90s, surviving the heavy crashes of the 2000s, and then surfing the historic bull run of the 2010s. Purely on math, index funds are the heavyweight champion for total returns.
But man, as an advisor, I have to warn you about the hidden agony of index funds. Because they lack a steady, automatic income stream, if you happen to retire right before a major crash, you suffer from this terrifying thing called sequence of returns risk. Remember, you have to sell shares to live, so doing that during a crash means you are permanently locking in losses at the absolute worst possible time. The simplicity of index funds is amazing, sure, but sitting through a crash with zero income just watching your life savings drop on a screen, it makes it intensely difficult to resist the temptation to just panic and sell everything.
Which brings us to part 4, taxes and hidden risks.
Look, neither path is perfect, and we absolutely must drag these hidden risks out into the light, because understanding the unseen drag on your money is just as important as knowing the potential gains. First up, taxes. Listen to me, dividends are not free money. When a company pays a dividend, its stock price actually drops by that exact amount. But more importantly, those dividends are taxed annually when you receive them. Yep, even if you just automatically reinvest them. This creates a constant sort of tax friction that actively slows down the compounding of your wealth. Index funds, on the flip side, trade way less frequently. This lets your gains compound highly efficiently over time because you get to defer those capital gains taxes until you actually sell.
But dividend investors face their own really unique dangers too. By only picking companies that pay out cash, you face massive concentration risk. Your whole portfolio might end up stuffed to the brim with just, say, utility companies, banks, or real estate. And that means you completely miss out on the explosive growth of other sectors, like tech. Plus, nervous investors often fall right into the yield trap. Chasing these massive 7 to 9% yields might look incredibly tempting, but it's usually a blaring siren warning you that the company is struggling, the stock price is tanked, and they're probably about to slash that dividend, leaving you holding a very empty bag.
All right, the moment of truth. Part 5, the ultimate strategy showdown.
It's time to put these two heavyweights head to head. When you weigh these features against each other, the picture gets pretty clear. On pure total returns, ultra-low costs, and tax efficiency, index funds are the undisputed mathematical winners. But look closely at the psychology of it all. Index funds can be incredibly mentally brutal during a crash because of that sequence of returns risk. Dividend investing, even though it carries concentration risk and that annoying annual tax drag, well, it is the undisputed champion of psychological peace of mind, all thanks to that steady, predictable cash flow.
And honestly, that brings us to the absolute most important takeaway of this entire explainer. The math simply doesn't matter one bit if you panic and sell during a downturn. The biggest financial catastrophes I ever see, they don't come from someone picking a slightly less tax-efficient portfolio. No, they come from bad behavior. The absolute best plan for you is just the one you can personally stick with, without wavering for 3 straight decades. So, before you make your final choice for how to fund your retirement, I want you to ask yourself this one absolutely vital question. Will your strategies survive your own human nature? When the market drops 30% out of nowhere, will you actually have the icy discipline to sell off shares? Or do you know deep down that you absolutely need the comfort of a cash dividend hitting your account to be able to sleep at night? Think really carefully on that. Because truly knowing yourself, that's the greatest investment strategy of all. Thanks for exploring this with me today, and keep learning.